When the goods have been sent at the invoice price, you have to bring out the difference between the invoice price and the cost price. There are three types of commission. One is called ordinary commission, second one is called deal creator commission, third one is called overriding commission. In a consignment, there are two parties. One is called the consignor, another is called the consignee. The agreement that takes place between the consignor and the consignee we call as consignment. Hello my dear student, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. I am going to hand Financial Accounting 2, second semester, Unit 3, Session 1 in favor of Consignment Accounts. I am going to explain what is Consignment Account. So before going, I will show you, it is a transaction in which principal send goods to his agent to sell them on behalf of and is risk in return for an agreed commission on sale. In a consignment, there are two parties. One is called the consignor, another is called the consignee. The agreement that takes place between the consignor and the consignee we call as consignment. I will repeat. In consignment is an agreement between the two parties. One is the principal. Principal is called the consignor and the agent is called the consignee. So, in a consignment, there are two parties. One is the consignor and the consignee. The agreement that takes place between the consignor and the consignee we call as consignment account. I will repeat. Goods will be sent by consignor to consignee. Consignee will sell the articles on behalf of or there is consignor for a commission. What is the duty? It is an agreement between the consignor and the consignee. Consignor is the owner, consignee is the agent. The agreement between the consignor and the consignee is called consignment account, whereas consignee will sell the goods on behalf of at the risk of the consignor for a commission is called consignment account. So, when you start the consignment account, how the format goes? Now, first one. Goods sent on consignment account at invoice price. This is the goods sent by consignor to consignee at the invoice price. Whatever the expenses met by consignor for sake of consignment is called expense of the consignor. Then this is the expenses of the consignee. The consignee met in expenses on behalf of the consignor. Then this is a commission payable to consignee. Then loading means difference between the stock reserve means real cost and the invoice price and the real cost is called the stock reserve. Whereas the goods has been sold by the consignee goes to sales account. Then we have to calculate the abnormal loss. Abnormal loss only occurred if any goods is lost during the transaction. Closing stock means unsold stock which can be realized. Then whatever the difference we called account is a profit. This word loading or stock reserve. This word, no, when the goods have been sent at the invoice price, you have to bring out the difference between the invoice price and the cost price. What is invoice price? What is the cost price? I am going to say that invoice price is equal to cost plus profit. Here. When the goods have been sent at invoice price here, goods sent on consignment here, it includes the cost plus profit. Cost plus profit is there. Then consignee will sell the article. So it should be more than the invoice price. Abnormal loss, no. If any loss occurred, how to calculate the loss? I will explain. This is the consignee account. When the goods have been sold, the entire sale amount lies with the consignee. Whatever the advance given by the consignee will be deducted. Whatever the expenses met by consignee on behalf of the consignor should be deducted. Whatever the commission payable to consignee also should be deducted. From the sale, whatever the balance left over, that will be sent by consignee to consignor. I will repeat. When the sales has been made, when the sales has been made, the entire sales amount lies with the consignee. What he will do now, he has given some advance either in the form of a check or in the form of a bill. If they give the form of a bill, it is called BR. If they given in the form of check, it is called bank. This is the advance given by the consignee to consignor before the consignment start. Now he has to recover the advances out of the sale, and he will deduct his whatever the expenses met by him will be recovered from the sale. Whatever the commission payable to him recovered from the sale. Whatever the difference left over, that amount will be sent by consignee to consignor. I will repeat this one. When you make the sale, the entire amount lies with the consignee. He does not want to sell all the amount because he will deduct his advance, he will deduct his expenses, he will deduct his commission, whatever the leftover, that will be sent by the consignee to consignor, either in the form of a check or in the form of a demand draft. That's one point. Then, there was an abnormal loss account. How to calculate abnormal loss, I am going to explain you. Here, abnormal loss account, I will tell you how to calculate the working note calculation of abnormal loss. Goods lost in transit, then add expenses, that is non-recurring expense of the consignee. I am going to explain what is non-recurring expense. Only non-recurring expenses of the consignee. So generally non-recurring expenses are loading and unloading charges, octroi, carriage on purchases, and insurance. These are all called the direct expense, should be taken into consideration. So which are the articles? One is called loading charges, another is called unloading charges, carriage on purchases, octroi, dock dues, and insurance. Carriage on when the goods have been what's called insurance is made on the goods should be taken into consideration. Other recurring expenses like advertisement, sales expenses, other expenses should not be considered. This is called non-recurring expenses of only the consignor because the goods is not reached to consignee. The goods have been lost in the transit, is not reached to the consignee. Only the cost price should be taken here. No invoice price, only the cost price should be taken here. Goods lost in transit value, only cost price. Only cost price should be taken. Add non-recurring expense of the consignor, the total value will come out of that amount recovered from the insurance company. Whatever the percentage in examination is given, that percentage should be deducted. Difference is called abnormal loss. That abnormal loss will be taken into consideration here. Here, to consignment account, totally abnormal loss. Whatever the amount you recovered from insurance company you are going to pay, the difference is the loss to the company. Out of abnormal loss account, some amount is recovered from the insurance company. The difference is called profit and loss account. Then if they ask to prepare goods sent on consignment account, you have to write by consignment account. This is as per the invoice price. As per the invoice price, out of that, stock reserve should be calculated. Then whatever the difference comes to trading account. I will explain what is this invoice price also. Here, cost plus profit is equal to invoice price. Assume that cost is 200, invoice is 240. So you send the goods here, assumption, goods sent on consignment account at 240. How much more? The 40 rupees, no? That 40 rupees will come here under the stock, loading or stocking. 40 on goods sent on. How much extra money will come? That should be shown here. Even the closing stock here 40 rupees on the closing stock. 40 rupees on the closing stock, unsold stock should be shown. Only the excess amount should be shown. That's called the cost plus profit. So I told you, no, here invoice is cost plus profit. If the cost is about 200 and the invoice price is 240, how much extra? The 40 rupees. That 40 rupees here, goods and stock reserve, loading or stock reserve. 40 in the goods sent on consignment here. Here, 40 rupees on the closing stock. Whatever the difference comes, that is the profit, general profit and loss. If the things come to debit side, it is called profit. If the difference come to credit side, it is called loss. Then in consignment account, when you make the sale lies with the consignee. He will deduct his advance, deduct his expenses, deduct his commission, whatever the balance left over, that is sent by consignee to consignor. Then here, this is a consignment account which includes the invoice paid by insurance company here. The consignment account, what is the total loss? Then this is the amount recovered from insurance company. Whatever the difference comes, that's a profit and loss account. Regarding this, by consignment account, as per the invoice price, stock reserve means extra, just like 40 rupees on goods sent on consignment account, which is called loading. Whatever the difference comes, that is really entry into trading account. Here, calculation value of abnormal loss. How to calculate the abnormal loss? Goods loss is translated only the cost paid, add expense, non-recurring expense of the consignor should be added. Then whatever the amount recovered, that should be from the insurance, that should be deducted. Whatever the difference comes, that is called the abnormal loss. Then valuation of closing stock, which how many article is not yet sold, that should be taken into consideration. The value of the stock unsold, add proportion expense of the consignor, non-recurring expense of the consignor, add proportion expense of the consignee. This is called non-recurring. This is non-recurring expense of the consignee. Then should be added. There is the value of the closing stock that will come in your credit side of the consignment account. Here, what are the non-recurring expenses? Non-recurring expenses are loading charges, carriage on purchase, octroi, dog dues, insurance on goods, unloading charge. This should be considered. Don't take into consideration direct expenditure. Direct expenditure like advertisement, sales expenses, other expenses should not be considered. These expenses should be considered in valuation of abnormal loss and closing stock. In valuation of abnormal loss, only consignor expenses should be considered. While valuing the what's called closing stock, we have to consider unloading what's called indirect expense of the consignor as well as the consignee. Once again, I will explain what is consignment account. Consignment account is an agreement between the consignor and the consignee. So, consignor is the owner, consignee is the agent. Agent will sell the goods on behalf of the consignor at the risk of the consignor. What is that? Consignee will sell the goods on behalf of the consignor at the risk of the consignor. Consignor is the owner, consignee is the agent. The agreement between the consignor and the consignee is called consignment account. So first, how it's called? Goods sent on consignment account. Who will send? Consignor to consignee. Whatever the expenses consignor made for that in order to send the goods, this is the expense of consignor should be deducted. When it's reached to consignee, consignee will meet the some expenditure, that's the expense of the consignee. Then he makes the sale. When he makes the sale, he has to meet some expenditure. The consignee has the expenditure. If the goods are unsold, the closing stock will come on the credit side. But if there is any loss during the transit, which is called abnormal loss, then we'll bring out the difference. The difference may be profit or loss. That's what you are going to say here. Goods sent on consignment account as per invoice price. This is the expense of the consignor. Then you have to show that the expense of the consignee. This is the commission of the consignee. This come back here. This is a sale made by the consignee. If there is an abnormal loss, that should be put it here. Closing stock means unsold stock, Then we have to calculate the stock reserve. Stock reserve we have to calculate only when the invoice price is given. That is extra money. So goods stock loading, you can say loading also or stock reserve on extra money. If it is told 200, 240, 40 rupees on goods sent on. So you have to make that is 40 into whatever the value of the goods sent on. It should be multiplied. That's called the stock reserve. Here, stock reserve on the closing stock. Stock reserve on the closing stock. Whatever the difference comes, the difference is called profit and loss account. Then, this is the consignee account. When I make the sale, the entire amount lies with the consignee. Then he will deduct his advance, deduct his expenses, deduct his commission. Then whatever the difference comes, that we will send by consignee to consignor. Then here abnormal loss account. This is the total loss account. Consignment is the total loss. Out of that, whatever we recovered from the insurance company, the difference is called profit and loss account. So if they ask to put sent on consignment account, by consignment account as per the invoice price, you have to calculate the stock reserve, the extra money, then whatever the difference comes, that is called the trading account. I think what is the stock reserve I told you, no? If the cost is 200, 240, how much extra is there? 40 on the goods sent. Assume that they sent about 4,000 kgs. Assumption, it is 4,000 kg. What's the real cost? 200. Invoice price is 240. How much more? 40 rupees. You have to write here stock reserve on loading. Here consignment account, you say cost account 4,000 into 40. Extra money you have to write here. How to write? Real cost is 200, 240. How much more? 40 rupees. You have to show the real figure. This is as per invoice price. Here stock reserve unloading. How much extra is there? 40. On how many vehicle? 4,000. So 4,000 into 40. Then whatever the difference comes, that is actually trading account. So it is an agreement between the consignor and the consignee. Consignee will sell the article on behalf of the consignor. It is called consignment account. Then loading charges, carriage and purchase, outright, dock dues, insurance on goods, unloading charges. Regarding the commission, we have got number 1, ordinary commission. Number 2, Dilcredere commission, D-E-L-C-R-E-D-E-R-E, Dilcredere commission. Number 3, overriding commission. So commission, there are 3 types of commission. One is called ordinary commission. Second one is called Dilcredere commission. Third one is called overriding commission. So ordinary commission means he makes the sale more than the cost price. As per the agreement, the consignor will pay the some amount more than the cost price when he sell. No, some agreement, it may be 5%, 10%. Compensation is payable by consignor to consignee is called ordinary commission, we say. What is Dilcredere commission? When the goods have been sold, if there is any loss incurred by the consignee, by chance when he make the sale, when he could not recover the amount which is considered as a bad debt loss, that loss should be met by consignee only when Dilcredere commission is payable. If the Dilcredere commission is not payable, that loss should be met by, should be borne by consignor, not by the consignee. I will repeat this word. When the goods have been sold, if there is any loss of bad debt, that bad debt loss should be met by consignee when Dilcredere commission is payable, unless that loss should be met by consignor only. Then regarding the overriding revision, more than the Dilcredere commission, extra commission is payable to consignee, so that he can make more sale and bring them more profit to consignor, and he will get the more commission also. So the extra commission, if he want, he has to make the more sale, more than Dilcredere commission. They made a sale to the extent of 20%. By chance, if they increase to the 25%, it's called over, and extra 5% is there. For that, we pay the extra commission, because for 5%, what's called consignor will enjoy the profit, consignee will enjoy the commission. I will repeat, but when you make the more sale, profit will be enjoyed by consignor, commission will be enjoyed by commission. So there are 3 types of commission. One is called ordinary commission, one is called Dilcredere commission, one is called overriding commission. Hope you understand this. So what is consignment account? It is an agreement between the 2 parties. One owner is called the consignor, agent is called the consignee. The agreement between the consignor and the consignee we called as a consignment account. Consignee will sell the goods on behalf of at the risk of the consignor for a commission. This is an important one. And in examination, one major question will become from consignment account. If we know the format, that is definitely good. And also here generally invoice price will be given. So you have to learn the format. Once you learn the format, we can meet. I have shown the format. In the next session, I am going to solve one problem and another problem about the consignment account, how it will be involved, how the goods have been sent, how we have to calculate. All will go detailed. We'll have one more one in the next session. We'll have some more problem about the consignment. Till then, goodbye. Meet in the next session.